Recessions have shaped economies throughout history, with significant impacts on society. Understanding historical examples provides valuable insights into their causes and consequences. One notable example is the Great Depression of the 1930s. Triggered by the stock market crash of 1929, this severe economic downturn led to widespread unemployment, bank failures, and a dramatic decline in consumer spending. The effects were felt globally, with countries struggling to recover for years. This recession highlighted the dangers of speculative bubbles and the interconnectedness of global economies. Another significant recession occurred in the early 1980s. Triggered by high inflation and aggressive monetary policy, the United States experienced a double-dip recession. The Federal Reserve raised interest rates to combat inflation, leading to reduced consumer spending and increased unemployment. This period underscored the impact of monetary policy on economic stability and the delicate balance between controlling inflation and fostering growth. The 2008 financial crisis serves as a modern example of a recession rooted in financial market problems. The collapse of the housing bubble, fueled by risky mortgage lending practices, led to a severe credit crunch. As banks faced massive losses, consumer confidence plummeted, resulting in a sharp decline in spending and investment. This recession had global repercussions, highlighting the interconnectedness of financial systems and the importance of regulatory oversight. The COVID-19 pandemic triggered a unique recession in 2020. Lockdowns and restrictions led to unprecedented declines in economic activity. Industries such as travel, hospitality, and retail were hit hardest, resulting in massive job losses. Governments worldwide implemented stimulus measures to support individuals and businesses, showcasing the role of fiscal policy in mitigating recession impacts. This recession emphasized the vulnerability of economies to external shocks and the need for adaptive policy responses. The 1973 oil crisis also serves as a critical historical example. A sudden increase in oil prices due to geopolitical tensions led to stagflation, a combination of stagnant economic growth and high inflation. This period forced many countries to re-evaluate their energy policies and highlighted the impact of supply shocks on the global economy. The recession of 1990-1991, often referred to as the Gulf War recession, was triggered by the invasion of Kuwait by Iraq. The resulting uncertainty and rising oil prices led to reduced consumer confidence and spending. This recession demonstrated how geopolitical events can have immediate economic consequences, affecting markets and industries worldwide. Each of these historical examples illustrates the multifaceted nature of recessions. Economic, financial, and psychological factors intertwine, creating complex scenarios that can lead to downturns. By studying these events, policymakers can better understand the dynamics of recessions and develop strategies to mitigate their effects. In conclusion, historical recessions provide critical lessons for navigating future economic challenges. The Great Depression, early 1980s recession, 2008 financial crisis, COVID-19 pandemic, 1973 oil crisis, and Gulf War recession all highlight the diverse causes and impacts of economic downturns. Understanding these examples equips society with the knowledge to respond effectively to future recessions. By recognizing the interconnectedness of global economies and the influence of various factors, proactive measures can be taken to foster resilience and stability. The journey through economic history reveals that recessions, while challenging, can also serve as catalysts for change and reform. By learning from the past, society can work towards a more stable economic future, minimizing the impact of recessions on individuals and communities. Ultimately, the key lies in understanding the lessons from historical recessions and applying that knowledge to create a more resilient economy. With informed strategies and a focus on adaptability, society can navigate the complexities of economic downturns and emerge stronger. Recessions may be an inevitable part of the economic cycle, but with awareness and preparedness, their effects can be lessened, paving the way for recovery and growth.